Central banks and gold, that's our main focus today on Commodities Confidential. Who's buying, how much, and are we headed to another record year? I'll be asking Jeffrey Christian, Managing Director of CPM Group, all this up next. Joining me now from New York is Jeffrey Christian, Managing Director of CPM Group. Jeff, everything really does come full circle. We kicked off Commodities Confidential with you 4 weeks ago, so it's nice having you back on the show.
It's good to be here.
Jeff, let's talk central banks. A report earlier in the month showed that GFMS suggests central banks to buy 280 tons of gold in the first half of 2013. If we compare this to 2012, where 563 tons were bought, could we say we're off to a good start? What's CPM's sentiment in regards to this?
Well, central banks have been net buyers for several years now. 12 million ounces, 12.4 million ounces. Last year, it looks like central banks will come in as net buyers of about maybe 14.6 million ounces. The largest buyer has been Turkey. And I should stop here and say the largest additions of gold to monetary reserves have been in Turkey. Because I think one of the things you need to do when you're looking at central bank gold inventories, monetary inventories, whether they're rising or falling, is you have to say, well, are these purchases, are they long-term purchases, are they short-term purchases? You know, in Russia, in some other countries, you have governments diversifying their portfolios or monetary reserves into gold, and so those are long-term purchases. And Turkey, which was the largest buyer last year, Turkey has this gold for gas trade going on with Iran right now, and it is also finding difficulty selling now some of its gold outside of Turkey because the U.S. government and the Europeans are threatening that they may say that that gold is Iranian gold and should have been embargoed. So what you're finding, I think, is that Turkish monetary reserves are rising in part because of the gold for gas trade with Iran right now. And that could be something of a temporary issue. That said, it's quite clear that central banks have been diversifying into gold since 2008, and that they're probably going to continue to diversify in 2013 and going beyond.
Jeff, if you had to choose, would you say this central bank buying is a contrary indicator or a positive one?
I think it's a positive indicator for gold prices. The fact is that central banks, for many years were net sellers, about 14 million ounces on average from the late 80s until around 2006, 2007. And what you've seen is a big shift in central banks' footprint in the international gold market, from being a net source of 14 million ounces of supply a year to being a net source of demand on the order of 12, 13, 14 million ounces a year. And I think that that's going to continue. That tightens the market, and that is being reflected in higher gold prices, and it should be expected to continue to be reflected in higher gold prices.
Right, Jeff, but it seems that it hasn't helped move gold prices to that $1,900 mark, or is it just too early to tell?
Well, I think there are other factors that are limiting the gold price. One of the things is that central bankers tend to be very cost conscious or price conscious. They don't like to be seen driving the price higher. There are central banks that will have target prices, and when the price gets above that level, they pull back from buying. You've even seen some central banks that are long-term buyers come in as sellers at times when the price gets very high. So a central bank that might have been net buyers in 2006, 7, 8, 9, when they saw the price spike up in the middle of 2011, actually sold some of the gold, took profits, and then came back in as buyers, replacing those profits after the price fell back after September of 2011.
Jeff, could it be that central banks have just become smarter in terms of their buying?
It could be said that, but I think it would be untrue. I think most central banks have been very smart in their buying and selling of gold all along. I think that, commentators in the gold market who often talk about things they don't know often criticize central banks inappropriately for things that central banks either aren't doing or that the commentators simply don't understand.
Jeff, let's quickly recap CPM's forecast for gold for 2013 and what you think could possibly impede it from hitting $1,900 or even passing that.
Well, we see gold prices in the next several months, the rest of the first quarter, actually trading maybe with a high of 1730, 1750, and a low perhaps as low as 1580 or 1530. So we see gold prices declining. And we see that because we think that investors, private investors, as opposed to central banks, are going to continue to be very price conscious. We've seen some price strength this week, but if you look at the gold market, most of the strength in gold prices this week was basically profit taking of people who had sold or bought $1,700 puts in the February COMEX contract. So they were taking profits on those positions over the course of this week. You had a fair bit of that buying, and you had short covering, and you also had the roll out of the February futures contracts, and those things drove the price up this week. But if you look at the gold market, even though investors continue to buy, they're buying at lower prices.
Jeff, how much weight would you place on jewelry demand weighing on the price of gold right now and scrap supply coming back into the market? Is it stalling gold prices?
Gold jewelry demand is very price sensitive, so when the price rises, you'll see investors or consumers and jewelry manufacturers both back away from buying gold. And with the price a little bit lower than it has been in 2011, in late 2012 and early 2013, you're actually seeing some increase in gold jewelry demand as people become more desensitized to the higher gold prices that we have. There has been a fair bit of gold scrap jewelry coming in, both because of people who own jewelry wanting to take advantage of high prices. And as the price has weakened, they've started saying, okay, this is a good time to sell this stuff. And also because of economic distress. People need money, and so they're selling gold jewelry.
Jeff, I know you're not a trader, but if you had to look at a longer term thesis for gold, what's an interesting number for you?
I would possibly be a buyer of gold on a intermediate term basis around 1500, 1530. From a longer term perspective, I'd probably be a buyer around 1500, 1530. And then, from a shorter term perspective, I would be interested in higher prices, but just looking to trade ranges.
Jeff, let's look at some key events that happened this week, starting with Wednesday's FOMC meeting and the Fed sticking to a relatively easy U.S. monetary policy. Basically, they'll continue to purchase bonds on a monthly basis. What does this translate to for gold? And basically, how much is gold at risk based on the Fed's actions, Jeff?
Well, I think one of the things that you've seen in recent months, I was talking about investors still interested in gold but being more price sensitive. One of the themes that we're seeing among gold investors is they're moving away from this, I have to buy gold regardless of the price because it's going to rise because of inflation and because all of the monetary policies, not only at the Fed but also in Europe and Japan and elsewhere, are inflationary. You're seeing investors move away from that and saying, you know what, this has been going on for years now, and you could argue it's been going on for decades, and it hasn't led to inflation, and maybe I should worry about inflation at some point when I see it arriving, but not necessarily. So I think one of the things you're seeing, and I think you saw it this week, is that the market is becoming a little inured to FOMC meetings and other individual specific data points.
Jeff, you mentioned a keyword, inflation, and that was a word that came up often yesterday during the FOMC. Is that an important signal?
And I think what the Fed is saying is they're not seeing signs of long-term inflation at this point, so they don't have to be as concerned about inflation as some of the people in the gold market and in the broader financial markets have been saying they should be. And I think that that's a very important signal to the markets that the Fed, at least, and really a lot of other economists at other central banks and in the private sector are saying, yes, these things could have long-term inflationary implications, but they haven't been having them now. And a bigger problem is deflation and low growth rather than inflation at this time.
Jeff, prior to the FOMC, a Bloomberg survey came out indicating that 32% of respondents expected QE to end at the end of 2013, and another 30% expected to end at the start of 2014. Where do you stand?
I look at the Fed's monetary accommodation policies. They're going to do whatever they need to do for as long as they need to do it. They've said that. They've also said that they're looking at a targeting 6.5% unemployment rate before they really back away from being as accommodative as they have been. If you look at the unemployment, the decline in unemployment rates from 10% in 2009 to about 7.8% now, it may well be early 2014 or even into 2015 before you see that kind of 6.5% unemployment rate that they've said is a target for them to back away from monetary accommodation. So, I think people who are trying to guess when the Fed backs away from QE probably it's like rolling dice as opposed to playing cards. You can't count the cards and you can't calculate the odds that well.
Jeff, with the time we have left, just want to get some quick thoughts from you on platinum. Some people expecting it to outpace gold. We did see it taking a bit of a dip earlier in the week after Amplats announced it was going to put on hold its plan to cut 14,000 jobs. What are your thoughts on the metal?
We think that platinum and palladium prices probably will strengthen. We like them as longer term investments. I'm a little bit embarrassed right now because I had thought that the prices would back off in the first half of this year and then be strengthening in the second half of the year. And what we've seen is basically the investment community anticipating stronger prices in the longer term and jumping into platinum and palladium in January of this year as opposed to waiting for slightly lower prices. That said, I think that there is scope for prices to back off a little bit, especially as investors sort of regroup and rethink what their posture is. But I think from a longer term perspective, we like platinum and palladium.
Jeff, when you say back off, to which price points?
I'm not a screaming bear. Maybe you could see platinum prices fall back below 1,600 briefly at some point this year. I think that'd be a very strong buying opportunity. In terms of palladium, I'm not quite sure how low it would go, but I wouldn't be looking for it to go back to the lows of the last couple of years.
Jeff, that's all the time we have for today. Thanks for being with me.
It's always a pleasure.
And thanks for watching this edition of Commodities Confidential. You can email us any comments or questions at newsfeedback@kitco.com or join the conversation on Twitter at Daniela Cambone. Thanks for watching.